and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha and with me is Nigel Dsouza, back with your daily dose of commodities, currencies and cryptos. But what are we focusing on today, Nigel?
Well, we have a comprehensive coverage on all the commodities over the next half hour. We'll take the discussion forward. Giovanni of UBS will be joining in. We'll also talk all things crude with Claudio, who will be joining in. So we'll focus on both those two big segments later on. But before we get to that, let's focus on what the markets did. And we had the second straight day of gains on Wall Street. Yet another concluding high for the S&P 500, which closed the session higher by close to around 0.5%. Tuesday marked the 11th record closing of 2025 for the benchmark indices. The 30 stock Dow, well, it climbed close to around 180 points by the time it wound up. The tech-heavy Nasdaq composite, well, that, on the other hand, was a little bit lower, down close to 0.4%. So relative underperformance is what we saw. Chip stocks, they took a hit, and that was the reason why that index underperformed. Well, stock futures, they're comfortably in the green, however. Meanwhile, it's green across Asian markets after the US President Donald Trump announced that a massive trade deal with Japan, setting tariffs at around 15%. Stocks in the Nikkei skyrocketed with an up move of close to around 3%. And you had individual stocks, particularly the auto majors out there, that were up between 5 to around 15%. Back home, the Indian benchmarks, well, it's managing to hold on to opening gains. That said, the Nifty is still maintaining its stance above the 25,100 odd mark. However, the 25,250 mark could be the near-term resistance.
Oh, well, absolutely. It is all about the tariffs and the kind of trade agreements that we're seeing coming in with the US, with our various trading partners there. But when you look at the crude oil prices, well, there is some support on that. Because of these trade deals, especially with US and Japan, the prices have steadied after that. We did see prices fall for the last 3 consecutive sessions, but not today, not on your screens right now. The polls also showing a fall in US stockpiles when it comes to the crude inventories also has been supportive. Last week, we did see a stronger demand indications coming in as well. And shifting focus now to currencies, well, most Asian currencies are edging higher as you can see, the dollar index continues to remain on a weaker side, still trading below that 98 level. While the Japanese yen was largely steady, the investor sentiment in Japan remained cautious amid ongoing political uncertainty following the ruling coalition defeat in the upper house elections and growing speculation over Prime Minister Shigeru Ishiba's potential resignation. Well, moving on, let's talk about all those commodities then and tell you on where they can be headed and what is the kind of demand, supply, production numbers coming in. Giovanni Staunovo of Commodity Analyst at UBS now joins us live for that. Giovanni, hi, good to have you. And I really want to start with precious metals first. The kind of moves that we've seen come in for silver trading at 14-year highs in the international markets. I must tell you that silver prices in India are trading at an all-time highs. It has been a strong surge. Silver is outperforming gold at this point in time. At these current levels of $39 an ounce plus, where do you see silver prices going from here? How would you look at this current year ending? And also if you have a range for 2026.
We have currently our forecast at $38 an ounce. We had a positive outlook for silver, expecting it to outperform in recent months. So the move that we have seen more recently has been rather on the stronger side. I believe some special factors like tariff fears, concerns are an element triggering some tightness. We see these elements also impacting platinum group metals. The bars missing in part of the world and ending up in other parts of the world. This creates this tightness which supports prices. And what we have seen also in the past is this feeling that all these white metals underperformed gold. And with that, we have seen prices doing fine, investor jumping on underperformers and expecting them to outperform. The challenge that I keep having is that we should still see a slowdown in economic activity. Silver is an industrial metal to a large extent. 15% of the demand is linked to industrial activity. We have also solar panels, which are an important element for silver demand. Here, I continue to see some near-term challenges. So I would expect that there could be some temporary price back taking place. But on the other hand, we need also to admit that eventually gold price could trend higher from here, and that gives also a boost to the silver price. So the forecast, $38, a bit cautious in the near term.
Oh, a little cautious, Giovanni, on silver. What about gold? I missed the level out there. That's in the last 24 months done very, very well. Yes, you would quibble if you say that silver actually has outperformed gold, but otherwise that's a relatively safer asset. Where do you see that headed?
So you're correct. This is an important element that we keep saying on a constant basis. Gold is volatile, but it has a volatility of 10 to 15%. The white metals have volatility of above 20%. So if an investor wants to have safety, security, then we prefer to have investment in gold instead of the white metals. The other ones are more for short-term oriented possibilities. The gold forecast that we have is $3,500 an ounce. Definitely what we are watching out is essentially the ongoing pressure from President Trump and the administration on Jerome Powell, the Fed chairman. There is a desire to see interest rates falling aggressively in the US. If that happens next year, then obviously the gold price would be trading considerably higher. And then we are talking about our upside risk case of $3,800 an ounce for the gold price. At the moment, it's 3,500. Central bank activity has been solid. We should get more insight next week at the end on July 31 when the World Gold Council will release its second quarter gold demand trends report. We finally figure out how strong central bank demand has been and how the other elements on the demand side have evolved.
Giovanni, as you said, you're more bullish on gold rather than silver right now, but with the way the silver prices seem to be holding at this point in time, $38 an ounce is what you believe is an average for silver prices. But what is an upside that you're looking at? Because most of the banks and brokerages seem to be talking about $40 and beyond. And also, how would you look at platinum? You mentioned about that on how the white metals within the precious metal category seem to be doing good. So how would you look at a silver range then, downside and upside both? And are you a buyer in platinum also at these current levels?
So on the silver side, that definitely something to watch out is industrial activity. If we get rate cut and that supports economic activity, then potentially I would start to see that as an opportunity to increase exposure to the metal. But at the moment, rather cautious. Obviously, many factors moving around, lower interest rates. So if we are talking about the upside case for gold, that would also mean that there is an upside case for silver prices, with prices staying above $40 an ounce. But at the moment, our base case is 38. You mentioned correctly that platinum has been a star performer this year. We were holding a positive outlook, but it has surprised how much it has increased. And I see two factors supporting platinum. Essentially, what we are seeing is an extreme tightness here in Zurich, one of the important markets for the platinum, and the other one in London. Essentially, the bars are shifting to the west, into the US, and here it's the tariff sphere that are just triggering demand out of the US, because we don't know if in a few weeks' time we might have 20, 30, 50% tariffs on bars. So there is an incentive to shift those bars to the US. Then there is also uncertainty if South Africa will have a tariff. So South Africa is the largest platinum exporter and producer, and therefore this is one element. The other one is very strong demand out of China. It's now 3 months that Chinese platinum imports have been very elevated. So this triggers this tightness in Europe, and this is the key price location for platinum, and that's why the price has been so elevated. The uncertainty is very clear. Do we get these tariffs? I'm a bit skeptical on that side. And also on the Chinese demand, yes, historically it used to be very price sensitive. This time around it's less. But these are jewelry producers buying the metal and create jewelry. It's unclear to me if end consumer will buy this jewelry at the end and see then demand support kicking in and keeping the price supported. So also here, a bit of cautious outlook in the near term, rather looking for price setbacks. But the market is extremely tight and the price can still stay supported in the near term.
All right. What about industrial commodities, Giovanni? Copper, any comment on that? I think Glencore was looking at shutting down 2 of their mines, or, copper mines. And as we know that there is some kind of shortage, while demand is expected to remain rather strong. And that explains why copper prices have been holding very, very steady. Any view on copper prices from here on?
So essentially, the main story was this tariff announcement of President Trump in recent weeks. This is creating two type of markets again: Western market, so the U.S. market, the COMEX market, and the London market. There is a disparity, and this trend is likely to continue. That these traders try to move as quickly as they can bars, metals, quantities from Western outside of the US to the US location. And with that, we expect in the near term this COMEX price to stay supported and London metals prices to come eventually in the near term a bit under pressure. But essentially, the longer term trajectory remains positive. Clearly, the energy transition is still a topic in the market, although it's going on a bit slower than everyone expected. But essentially, there is still a desire to use more renewables energy sources going forward, and that's an element which should support the copper price. And here we look still for a price move above $10,000 a ton.
So bullish for gold and platinum and copper, not so much for silver. Giovanni, thank you so much for joining in today and with your sense on all of those commodities prices and, of course, the fundamentals that seem to be moving many of those there. With that, it's time for a short breather on the show. On the other side, we'll be joined by Claudio Galimberti of Rystad Energy with all things crude oil. Welcome back. We are now joined by Claudio Galimberti of Rystad Energy. Thank you so much, Claudio, for your time with us. Well, crude oil prices have been quite volatile. 3 days of decline, and today seems to be slightly supportive in that sense. A lot of contradicting fundamentals as well. What's your sense, first of all, on the crude prices from here, and what is it that you're watching in the international markets?
Thank you for inviting me back. Always a pleasure. It's obviously a very complicated question, but we can probably simplify it and say that there are at least 3 main factors that we need to bear in mind. The first, number one, is what OPEC Plus has been doing, which is a significant release of the cuts. So the unwinding on the cuts has taken place at a much faster pace than previously anticipated. Number two is the tariff policy by the US administration. For sure, this is an extremely important piece of the puzzle, and that is anybody's guess, right? So there is a lot of uncertainty going on with August 1st being an important date at this point. And the third, which has probably been one of the most important factor in the past couple of months, is the geopolitical risk premium. So what's been happening in the Middle East with a very fragile ceasefire between Israel and Iran, and of course what's happening also between Ukraine and Russia. So I would say that these 3 are the main factors. Forecasting their direction is extremely complicated, specifically when it comes to geopolitical events. But overall, what we are forecasting is a increase inventories towards the end of the year, and this is on the back of OPEC Plus unwinding. So there is probably one of the most important signal here, fundamental signal, is that we will see increase inventory, and therefore there could be a downward pressure on prices starting in September.
Well, Claudio, I'm going to push you a little bit to give us a range. If you could give us some numbers, what are the levels you're working with?
On the downside, there is quite some pressure, right? So on the one hand, if OPEC continues to unwind production cuts at the speed that we saw for August, which is 550, close to 550,000 barrels per day every month, then we will soon be in a heavily kind of supplied market, which means that the prices can drop well below $60 per barrel. We would have a significant contango at that point. On the upside, this is where it becomes really difficult, because it depends really on the supply disruption that can occur as a result of military activity in the Middle East and in other parts of the world. So I remember last time you invite me in this television, we were talking about the potential for the Strait of Hormuz being blocked. Now that doesn't seem to be occurring, fortunately. But we need to bear in mind that the war between Israel and Iran slash its basically its proxy, its allies, keeps on going on. There is a ceasefire, but this situation has proven in the past to be relatively unstable and fragile. With some disruption in the Middle East, then you can see prices going up into the $80 per barrel, even 90. Currently, we are at 68. Which I deem as a fair price. So I would say that if you ask me a range, it also depends on the time, right? On the time horizon. So if it's over the next 2 months, obviously the range tends to be relatively narrower. If it's over the next 6 months, then we'll talk about a relatively large range. But I would look at the 60 and 90 as kind of the two bookends.
That's a wide range, $60 to $90. But I do get your point that there's just so much happening right now, and depending on what side we go is where the crude prices will follow. Claudio, you also talked about supply side of it, but I do want to understand about the demand side of things as well. How would you look at the overall global demand gain? And within that, we continue to talk about on how India perhaps is a shining bright star when it comes to demand. How are you looking the numbers for India?
So India's been a success story for sure for the past quite a few years, I would say. And the fact that India is very close to have a trade deal with the Trump administration is also a significant boost when it comes to the expectations. So I am more concerned about kind of the economies that are really dependent on the exports to function. And these are, as we know, Europe's number one, then China, and then you have some other economies, but these are probably the two most important blocks. And of course, Mexico and Canada stand to suffer a lot if the Trump's tariff are basically are established as appears to be the case as of August 1st. So we need to hope for a resolution of these kind of trade tensions with lower tariffs, because higher tariffs, as we know, tend to have a kind of a bearish pressure on the economic activity. When it comes to India, India currently is the third largest oil consumer in the world. We focused oil demand to continue to grow, probably at a rate of 100 to 150,000 barrels per day. So it's I have a relatively kind of optimistic focus for India.
All right, Claudio, let's talk about supply. Demand could be a little bit weakish, or it could be quite volatile. But on supply, how are you reading it? OPEC, non-OPEC as well, and also comment on OPEC Plus. They've gone ahead, and that supply cut is gradually getting unwound. Tell us.
When it comes to OPEC, at this point is anybody's guess, because they effectively have unwound all their one of the three layers of their voluntary cuts a year ahead of schedule. So at this point, what are they going to do starting in September? They can start unwinding another layer of those cuts, which would mean they can bring back into the market anywhere between 1 and 2 million barrels per day over the course of the next basically 6 or even fewer months. So that's they need to bear in mind, and of course they know this very well, that the more they bring back to the market, the more price pressure they would have. Let's not forget that most of these producing countries are petrostates, and therefore their finances very much depends on the oil price, and the oil price is heavily affected by the supply and demand. When it comes to the non-OPEC, what we have seen so far is a very strong growth in Latin America. So Brazil, Guyana, even Argentina have shown very, very strong growth in 2025. We have seen growth in Canada. When it comes to the United States, the expectation was at the beginning of the year we would grow at something like between 1 and 300,000 barrels per day. But with the price environment we've been in for the past 4 months, we haven't seen much growth. So the latest numbers are still 13.7, 13.4, 13.5 million barrels per day. So this means that when OPEC decides the policy for the fourth quarter, they need to bear in mind that we still have a lot of supply coming from outside of OPEC, which is almost price insensitive. So these barrels are primarily coming from deep water, from offshore, and they are literally in the pipeline. They will hit the market whether the oil price is 80 or 40. So this is a very important thing that OPEC will need to bear in mind.
Interestingly, so OPEC could be bringing in more supplies in the international markets. But I also want to talk about peak demand, and that's a statement that we've been talking about for the last couple of years now. Where do you see peak demand going from here? The markets believe that global perhaps would come later. Chinese peak demand could be slightly earlier. What are your own calculations on this one?
There is a huge kind of range of opinions talking about this. I spend actually quite a big portion of my time trying to understand how fast oil demand can be basically can be curtailed. Let me say this. So the most important engine of growth when it comes to oil demand in the past 15 years has been China. Due to its extremely fast industrialization, we saw in some years oil demand in China was growing at 500, in some cases even at 1 million barrels per day every year. This has come to an end. So this is probably this is the second year when oil demand in China will grow by less than 100,000 barrels per day. At some point, we could see, first of all, the road transportation demand in China plateauing. That can happen in the next 2 to 3 years. And at some point, maybe in the next 5 years, start to actually decline. And the reason is that in China, we are selling currently more than 50% of the new cars are actually electric vehicles. Now, this doesn't mean that the global oil demand is close to a peak, because, first of all, there is not just the road transportation sector that represents 40% of oil demand. The rest is not road transportation. And that 60% is actually not under threat. So there are not that many alternatives for oil in these other sectors. And the second is that even for road transportation outside of China, that continues to grow. So in the Middle East, in Latin America, in India, as we just discussed earlier, it continues to grow because the penetration of electric vehicle there is still limited. Therefore, if you ask me where can we see a peak, well, I would say according to Rystad Energy, no earlier than the early 2030s, and then we can have a relatively long plateau.
Claudio, a final question then. Apart from peak demand, the other raging debate, of course, has been oil versus the renewables. As we see electricity, renewables really working quite strong. Alternate fuel, what's your take on that?
When it comes to the technology, if I understand correctly your question, what are the technologies that are going to win and those that are going to not win or even to lose in the next 5 to 10 years? I mean, there are many. There has been a lot of investment in the past 15 years in developing alternative fuels, anywhere from ammonia and methanol, which are derivative of hydrogen, to biofuels, to advanced biofuels, to biomethane, and so on and so forth. So there has been really a very strong push coming from many countries, but specifically from 2 regions in the world, China and Europe, towards the development of alternative technology, literally trying to foster the energy transition to away from fossil fuel. In the US, we had the famous IRA. This was 3 years ago by the previous administration, the Biden administration, that tried to kind of leapfrog the whole industry in the United States and bring it as close as possible to the technological frontier, which is currently detained to some extent by China. But then President Trump was elected, and what we have seen in the past 2 to 3 months is really a dismantling of the IRA in the United States. Therefore, at least there is one main economy in the world which is kind of putting the reverse gear when it comes to the energy transition and doubling down on the fossil fuel. Therefore, I would say that your question is very, very pertinent and very profound. What I see, if 2 or 3 years ago there was really a rush by most of the largest economy towards the new the new technology, the clean tech. Right now, at least we see one big country, which is the United States, doubling down, reversing and doubling down on the fossil fuel. So this is it is shaping out to be a very interesting, in this case, kind of race, because now it's to some extent more diversified than it was just 2 to 3 years ago.
Well, all right. There's just so many fundamentals and issues right now which the crude oil as a market seems to be tackling with. But Claudio, as always, thank you so much for breaking it down for our viewers and for us as well. With that, that's all the time that we have on this episode of Big C. It's a big thank you from me, Nigel, and the whole team that put the show together. We'll see you again tomorrow with more news and updates.